Good afternoon, SFAR. Patrick Gardner, Michael Simmons, Anthony Blackburn, getting ready very soon to start our second discussion about appraisals and a behind the scenes look with our team. So we'll get started just a minute when we have kind of a core group on. Give us just a minute and we'll get started. Okay, so we have a core group in, so we're going to go ahead and kick off our event today. So behind the curtain, understanding the appraisal process, part 2. Thank you everyone for tuning in to our presentation today. We have 2 great speakers who are going to share stories, insights, and practical knowledge about the appraisal process. My name is Patrick Gardner, and I'm a loan officer with Guarantee Mortgage and chair of the Education and Events Committee at SFAR. On behalf of the committee, I'd like to welcome you to our Zoom call. As we get started with the webinar, I want to share some logistics for our meeting today. First of all Zoom audience viewers are on mute throughout the entirety of the presentation. The webinar is being recorded and will be available to view in the SFAR video library on YouTube. So check it out if you don't have time to stay through the whole thing. For today's presentation, we are planning to have much of the conversation be a dialogue of questions and answers. Please ask all questions through the Q&A box located at the bottom of your screen, marked Q&A. We will not be monitoring the chat feature during the presentation, but will be answering the questions asked through the Q&A box in the order that they come in. Our guests today are appraisal management experts who will answer questions and share their experiences candidly. Our first guest, Michael Simmons, founder, co-president of Axis Appraisal Management. Mr. Simmons has over 35 years in the real estate industry. His experience as a real estate agent, multi-branch manager for a national mortgage banker, and veteran mortgage broker experience gives him a unique lens into helping shape Axis Appraisal Management's critical commitment to relationship-based and service-oriented appraisal services. He oversees the sales group, directs the mergers and acquisitions team, and is an active on multiple industry organizations and councils. Welcome, Michael.
Thank you, Patrick.
Our second guest, Tony Blackburn, has been a real estate appraiser since 1986, when he was hired as a staff appraiser by a private money lender out of San Jose. He was hired by Apple Appraisal when it was a fledgling company, and Tony was a staff appraiser there until 1996, when he became a partner of the firm. Tony created the Apple Appraisal Review Department and managed it, directed it for several years, gaining a reputation for high quality review and methodologies. In 1999, Tony bought out the other partner of Apple Appraisal and was a sole proprietor to 2004, when Dennis Kearns came to be his partner. Tony led Apple Appraisal and its growth to an appraisal management company which serves California, Washington, and Nevada. Tony serves on committees for the Collateral Resource Network, a group of lending industry thought leaders focused on resolving many of the challenges facing the appraisal profession. Tony continues to be very involved in local lending community and speaks regularly at affiliated industry groups such as SFAR. Welcome, Tony.
Thank you. Thank you.
Real quick, can you guys give about a 1 or 2 minute synopsis about where the industry is right now? You know, just kind of give a temperature reading on, where things are, and how it relates to our general membership.
Sure. You want me to start, Tony, or would you?
Yeah, why don't you go? You have those lovely tones, so I'll follow you.
Thanks. So for the first time in a really long time, I think the industry is at a true inflection point. I think we're looking through a telescope and seeing that we need to modernize the functionality of how we prosecute appraisals. We need to improve the efficiency and speed with which we deliver reports. we're going to have to adapt to the fact that the use of technology is going to govern how and why we do certain types of assignments. And there are going to be a host of changes in terms of the old view of one size fits all. And I think that that's a big deal. I think it's scary for appraisers, but I think that, from my vantage point, what it really means is it's going to challenge all of us to be better at what we do, use tools more efficiently, and it will create more and more opportunities. Because I think the appraisal profession and the role that it plays in lending is probably the fulcrum point for successful markets everywhere. I think it's integral. It's the one independent, unbiased, which will be part of our discussion at some point later today, unbiased entity in an entire transaction. And I think it's vital that it remains that way.
If I could just say ditto to what Mike said, I would, but I'll throw in some of my own thoughts as well. Being an appraisal management company owner and somebody who's also in direct contact with appraisers all of the time, and I do appraisals out in the field myself, I get a kind of a unique perspective into the mind of an appraiser and how they're working. I just chatted with an appraiser for a while today and gave her some training, who was somebody just that works alone by herself in her in her home in Northern California, and she doesn't really have that much contact with the outside world, really. And that's how a lot of appraisers work. And so this time of change and this time of flux, as Mike was saying, this critical period that we really are in as appraisers, appraisers need to keep up. Appraisers need to be aware of the changes that are coming down the road. Appraisers that aren't aware of what's going on with all the changes coming in the practical application of being an appraiser, and also in the ethical and obligations of being an appraiser and holding the public trust. If they don't keep up with that kind of stuff, they're going to be left behind. And that could present more problems down the road. We all have our stories, even as realtors, over the past couple of years, of why is the appraisal so expensive? Why can't I get anybody to pick up that report? Why can't I get anybody to come out and do an appraisal? Why is it taking 4 to 6 weeks to get an appraisal done? A lot of these issues are being discussed right now. These are challenges that the industry is taking head on, and I think we're moving in the right direction. But the appraisers have to come along with us, and so I know that I, as an appraiser myself, do the best that I can to bring people along with us. And I think that's going to be one of the biggest challenges moving forward is making sure that appraisers are keeping up and staying abreast of what all the issues are going on right now.
Thank you guys very much for that clear and concise response. This is our second discussion together. And for those who want to see part 1 of the video, you can go to the SFAR library and check it out. It's the same name, Behind the Scenes. Before we jump into our main dialogue about the technical aspect of appraisals, I wanted to check in with our guests about some current events. Both Anthony and Michael brought up, ethical dilemmas that sometimes are faced by appraisers, whether it's, meeting a value of a contract or, maybe going somewhere where they're unfamiliar. There's all sorts of these dilemmas. One issue that came up recently was in Marin City, where it's alleged that an appraiser, a Marin home appraiser, is being sued for allegedly some race discrimination based on value that was given for a given appraisal. We don't know the value of the original appraisal. We don't know the value of the second appraisal that came in that was a dramatic difference. So the allegations include gross undervalue compared to another appraisal that was done shortly before. with only the difference being pictures removed from the family that was African-American family. We know that your firms are not involved in this suit, but how does something like this occur? And are appraisers mandated to take bias training or implicit bias training? And do you think they should? You know, what sort of standards are in place to protect the common person from being discriminated against through an appraisal?
Yeah, I'll take this one first, Mike. Yeah, this is a huge issue. That it's one of those issues that I was just talking about that appraisers have to stay abreast of and have to make sure that they're keeping on the forefront of. It's a complex issue, definitely a complex issue. But the bottom line for appraisers is we have to follow what's called USPAP. The Uniform Standards of Professional Appraisal Practice. And the very first line in there is that we have a duty to protect the public trust. The public needs to trust us. The public needs to have reasoning to trust us. Otherwise, being an appraiser doesn't really mean anything. And so bias is an important part of that because the public can't trust us as appraisers or us as an industry if they feel that we're going to be biased in any way. So it's a hugely important issue. On the practical side, I know of the appraiser, and we have been contacted by at least 2 local lenders that have asked to have her taken off the panel. And they don't even know if she's ever done any work for them before. And so there's the practical ramifications of, she hasn't even been convicted yet, but she's been convicted in the media. And that's a really difficult position. I would say that with this particular issue, this specific one in Marin City, there's a lot of information that has not been opened up to the public and won't be for quite a while. And so, I would certainly reserve judgment until everything's been laid out on the table. But it has brought up this issue for the lending industry and for appraisers that we really do need to look at. By and large, the appraisal industry were mostly old white men, and there's, I think, maybe 10 to 15% are women. Even fewer percent are minorities. And, that's a challenge because that doesn't reflect what the United States is, and certainly doesn't reflect what California and the Bay Area is. So I think we need to move in that direction of more diversity. I think we need to move in the direction of more education. The state of California is now requiring bias training as part of our licensing. That'll start on the next, for me personally, that'll start on my next round, which will be in 2 years, but it's going to start for appraisers here pretty quick. And we do have a long ways to go, and it's not only being addressed here at the state level, but at the national level with groups like the Collateral Risk Network that Mike and I are involved in. And this is a big topic of discussion at our quarterly meetings. And I think we have a long ways to go on it, and appraisers by law cannot discriminate. I think in a lot of practical, when you're doing your appraisal, a lot of times on a purchase, we don't see anybody. So we don't know a lot of times who is a buyer and who is a seller. So, there's all kinds of questions, and, a lot of this is going to be fleshed out over the next couple of years. But again, it's another issue that's a big challenge to the appraisal industry and the lending industry. And it's important that we address it, figure out how to fix anything that's broken and move forward.
Excellent. Mike, you have anything to add?
Sorry, I'm
No
trying
problem.
to get my mouse to get to my microphone. Yes. This is an extremely sensitive topic for a lot of people. And part of the problem is, I think Anthony touched on it, every appraisal is, for all intents and purposes, is confidential, only for the lender. Now, some of that's going to change here soon, because I think there are recommendations that are going to make the consumer one of the intended users of a report. Most people don't know that. Most people don't recognize that. Buyers and homeowners think that they're an intended user. They pay for the report. They're not. It's done for lending purposes. But the truth is, they are integral to everything that an appraisal discloses and opines on. So that's going to change. The other thing is that we know what the one value was for the appraisal. Came in at $995,000 in Marin County. And then we know that within a month or two, well, it wasn't very long, I think it's a month or two, that they did another appraisal and it came in at $1,495,000. So roughly $500,000 difference. Part of the problem with Marin City, where the property resides, is that there are limited comps, limited sales that define that market. I have no idea where either one of those appraisers got their data, their sales data, but pretty clear that if the second appraiser had to go outside of Marin City, and what's next to Marin City, Belvedere, Tiburon, Sausalito, I'm not sure that those would commonly be acceptable nearby comparable sales. You'd be in a different marketplace entirely. Now, is there something structurally wrong with the industry? Should all properties be valued the same if they have the same basic components? Well, what are the three things that we all learned when we first walked in the door of any real estate office or sat down and read any book? It's location, location, location. Well, if you want to throw that out the window, then you can make everything the same. But that's not the way the world works. The bigger issue here, in my perspective, is that appraising, lending, all of this is a reflection of our society. And if we have racial issues, if racism is a part and parcel of our daily lives, then we need to do everything we can to stamp it out. But first, we have to understand it and expose it. Now, I don't want to form another committee to study something. I'm not interested in doing that. Frankly, from a business standpoint, whether you're a realtor or a lender or an appraiser, if we could find a way to make more people of color eligible for loans, qualify for loans, interested in buying homes, I think everybody wins. But in order to do that, we've got to improve the educational system. We've got to have equal opportunities for jobs. And we have to have more people of color in the industries. We're the worst industry in the world in this country from a racial standpoint. We're 96.5% white. Part of that is because appraisers, grew themselves up in a guild system where they learned from a mentor. And that mentor was usually your father or your mother or your uncle. And they brought them in and trained them. And so you trained people who were like you. I mean, it's the same way when the Irish were carpenters and the Italians were masons and I forget who's the plumbers, but I mean, the fact is all the ethnic groups learned that way.
Let me cut you off right there, because I think, we can definitely talk about this issue for a long time, and it's great that we are. So I also sit on our diversity, equity, and inclusion committee, and we are committed to creating opportunities and funding opportunities for the parts and members of the association that may not look like the majority. So with that being said, what are some ideas that you have that are practical to get more opportunity for appraisers who are not Anglo-Saxon males into the industry?
So, yeah, that's a great question, Patrick. So there's a program being developed now called PAREA, Practical Aspects of Real Estate Appraising. In bringing up trainees, it used to be that credit unions and lenders would train people in droves. They don't have their own appraisal departments to any degree anymore, so they don't do that. So it's up to an individual appraiser. PAREA will allow AMCs to have a virtual training program to bring people into the industry. Instead of having a supervisor on a one-to-one basis, that applicant, that PAREA applicant, we can call them trainees if we want, will have mentors, multiple appraisers that they can mentor under and have review their work. And as part of that process, they can blossom into a full-blown appraiser over time. Actually, they should be able to do it faster. The challenge is not all states agree with counting all the hours for doing that. And this is where the political infighting is making it difficult, because PAREA, to get approval from the foundation, claims you have to have all of your hours under the PAREA banner. You can't do part here and part under a supervisor. But that stuff will get worked out. So there's systems that are taking place that will change the metric on how we train people. Part of the training too, I think, will attract people to the industry based on the new types of reports we're going to be dealing with. And I know you want to talk about desktops in a little while, but one of the things, Axis is actually building out a PAREA program. Unfortunately, there are only 5 AMCs that I know of that are doing this. And I think that's unfortunate, because we're not going to be able to solve the problem for everybody. But we can try. We can try.
Okay, so we have a chat message that I want to acknowledge, and that is I agree with your point of a lot of the trades were established through different ethnicities. Also, we have a history in this country, from the government to each side of real estate, that excluded a lot of people, African Americans, Chinese in California. Any major ethnic group was excluded that wasn't fitting in with the white paradigm. So I just want to put that out there as a reminder of the work that we need to do. That's important, and I do appreciate that Access is taking on this program, and it sounds like a fruitful endeavor. I want to switch gears now, because again, we can spend an hour or two or many more, and deservedly so, on that topic, but that's just one area that we need to cover, and we got a lot to go through. So real quick, there was a terrible tragedy that occurred in Florida, just outside of Miami, with the Champlain Towers, a 12-story condominium collapsing. And 90 people lost their lives, and many more were hurt. We have a leaning tower here in San Francisco that many are concerned about. Generally speaking, whether it's condos or single family homes, if there are issues that either are something that the appraiser sees, or that is somehow named in a report that they see, or called out in the contract, what obligation does the appraiser have to speak on it or to act on it, that discloses some information to the lender and is in a way a safety check?
Yeah, it's a big issue for appraisers, and it really it's not just limited to carbon monoxide detectors on water heater double strapping. Those are the common things that are health and safety issues that we hear about all the time. And FHA, there's not a lot of FHA lending that happens in the San Francisco Bay Area, but what little there is, appraisers are under an obligation from HUD to make sure that a property is safe and sound, and is free from structural defects. Now, that being said, Fannie Mae also has those requirements. And as appraisers, we follow Fannie Mae's guidelines, and their specific statement deals with safety, soundness, and the structural integrity of a property, whether it's a condominium, a manufactured home, or a single family home. Appraisers are required to, if there's something that impacts any of those things, we're supposed to address it. And that means reporting it or disclosing it, putting photos of it in the report, and addressing how it affects the marketability and the value of the property. If it's something that's relatively significant to a specific unit or a specific single family home, like the second story sliding glass door that has no deck off of it, or something like that, a interior balcony overlooking a living room that doesn't have any railing, those are obvious things. Exposed electrical, that's a common thing that we see all the time. Broken windows, those are fairly minor, and a broken window, for example, or exposed electrical because some outlet covers have been taken off, those aren't really going to impact the value of the property, but they will impact the safety of the property. And that's so Fannie Mae wants us to address those things. And so we'll write up the appraisal, and an appraiser will write up the appraisal subject to those things being corrected. Now, the Leaning Tower Pisa, or in San Francisco, our own leaning condominium tower, that's not so easy to fix. And, so there's limits on who will lend on it, for example, and that's not something that an appraiser can fix, but an appraiser is under an obligation to disclose it and talk about how it impacts the marketability and the value. Safety, soundness, structural integrity are important issues, and appraisers are under an obligation to address those things. They can't hide them can't sweep them under the rug.
And just for everyone on the line here, again, I'm a lender, and so I'm privy to various changes. And Fannie Mae this week, Freddie Mac, the industry standards have changed a little bit for condominium lending. They've changed what we call the lender cert, and they've added on there some language and questions about the structural integrity of the building. And so that's something that people who are filling out those forms need to document. And it hasn't affected lending on these yet, but as these weeks roll by after this rolling out, we think it will.
Yet.
Yeah, exactly. Yeah, it is the key factor there. So something to keep in mind. And Michael, do you want to add anything?
No, you guys covered it quite well.
Okay, well, something I know you have insight on is the desktop appraisal rollout. I think in October of last year, it was pitched to the Federal Housing Finance Agency, FHFA, which is the major overseer of loans at the federal level. It was presented in October that these be more incorporated into the lending process to streamline, smooth, and maybe take care of some things that are out of the norm that aren't addressed correctly right now. Hopefully they'll be helpful changes. What has been your insight? How do you see this moving forward?
So just first, I think just a little bit of background. When COVID first reared its head in the marketplace, and borrowers didn't want appraisers in the house, and appraisers didn't want to be in a borrower's house, and the fear was that the industry would grind to a halt. Fannie and Freddie initiated what they called the COVID flexibilities, where they allowed a desktop report done by an appraiser from their desk to be developed in certain cases for a certain strata of transactions. Now, what was interesting is that they still required the appraiser to do a physical inspection without physically inspecting the property, and then and then vouch that it was credible. And if they didn't feel it was credible, if they didn't believe it, or they didn't have sufficient data or information or evidence to support that information that they got, then they couldn't complete the appraisal. So what happened was there was a burst of activity to do desktops for a couple of months, and then it almost fell off the map and people stopped doing it. And I think in part because there was some technology where the homeowner could take and walk around and do an inspection of the house on a phone and take pictures and so on and so forth. And I suspect there are reasons why those desktops were unsuccessful. I think it had a lot to do with the appraisers being reticent to approach the values that were needed in what they might have done had they been able to visit the property themselves. But anyway, so that it was a surprise to Fannie and Freddie both. Well, when Sandra Thompson made that announcement in October, she said this is going to happen in the first quarter. Well, from the time she made that announcement until just 2 weeks ago, neither Fannie nor Freddie made any official comment at all about anything. They were just dead silent. And it was only within the last week and a half, I think, that Fannie, maybe 2 weeks, that Fannie sent out an announcement saying that they're going to do desktops on a limited basis, but they're going to require that there be a floor plan included in the physical appearance. Now, it's not required now in a full-blown appraisal. Floor plans aren't required. You have to do a sketch, but you don't have to do a floor plan with walls. So this added a wrinkle, because the only way you can get a floor plan is to use technology. And then it has to be specific technology that has the ability to create a floor plan from electronic measuring devices. So that means that either they need a whole cadre of inspectors, or they have to have a whole bunch of uber smart borrowers who can walk through a house and capture all that information, so all those technological advancements can go into effect. Now, first of all, that's Fannie's position. It's now almost the end of January, and Fannie said we're going to do this. This will start near the end of March, right? So it's going to be all the way through the first quarter.
March 22nd. Yep.
March 22nd. So to this point, Freddie Mac hasn't said a word. Now the GSEs include Fannie, Freddie, the VA, and FHA. We can set aside VA and FHA for the time being. They're kind of not part of the equation. But at some point, Freddie's going to have to step up, because they have to follow the marching orders of FHFA. But we'll see. So it's going to be interesting. That's kind of the backstory. The front part of all of this, and I think Tony will certainly add color to it, is that we need to re-engineer the appraisal process by bifurcating it, by having standardized inspections done by certified, trained inspectors to more efficiently go out, capture all of the information in the house, get that information to an appraiser. An appraiser can sit down and do an appraisal, right? Now, they can do a desktop, but you have to remember the desktop is really nothing more than a standard Fannie Mae appraisal with a slightly altered scope of work and a modified data set. It's not going to change. It's going to look like a regular appraisal, right? And for all the various reasons you might suspect, but so it'll be a regular appraisal, but a shorter one. But it'll be faster. I don't think it's going to be any cheaper, but I think it certainly will be faster, which is really what serves the industry, because time is the big killer here, right? If you can take and make an appraiser twice as proficient and twice as efficient. They can do twice that amount of work. So while you're growing new appraisers, you're going to be able to handle an awful lot of business, right? So that's really where we are. I think it's long overdue. I think there's some lenders, at Guarantee that you're going to have jumbo lenders that won't want any part of desktops, may not even be interested in having third-party inspectors, property data collectors is the term, doing the inspections. They want a full appraisal done by the appraiser, right? Those are jumbo lenders. Banks in particular will probably want that, but that's fine. Yeah, that's fine. Plenty of room.
I just want to add something real quick here, and then also answer a question that was asked that has something to do with this. So to kind of surmise here, what you're saying, initially in COVID, desktop underwrites were allowed at a higher rate. I know Wells Fargo was also allowing them in addition to Fannie and Freddie. They were okay with that initially through COVID because of the kind of unknown, scary, we don't want a stranger in our house inspecting our home. We don't want this to change or shift the industry. Let's do what we can to kind of offset, put a Band-Aid on this for a while. That passed. And then the appraisers stopped feeling comfortable with doing these desktop appraisals, particularly on a market trend going up in values. Like, oh, I don't know if I should do this. I need to go out and inspect to feel comfortable. Additionally, we're having the Fannie Mae FHFA folks wanting to increase these because of the demand on the systems, and also, hey, we want to rely on technology. Additionally, I'll say that Fannie and Freddie are typically the gatekeepers and like the norm setters for the industry. What they do over time, the jumbo lenders will start to do, what other people will start to do. So once they adopt this as normal, then we can expect other lenders to do the same. There was a question asked in the chat of, I see ads all the time stating that, come do this refinance with my company, and you may not need to get an appraisal. To answer that question, if the loan is underwritten by Fannie or Freddie, what we do as lenders is we run what's called the desktop underwriter, which is a automated system that runs and checks through the loan application and establishes whether or not, tax returns are needed, or W-2s, or what sort of statements and documentation is needed. Part of that is whether or not an appraisal is needed. If an appraisal is needed, it will say, please get an appraisal. The other option is an appraisal waiver. An appraisal waiver is basically where the lender and the borrower say, hey, we're comfortable with the value established in the system. We do not need an appraisal for this particular loan to go through. Now, that doesn't happen all the time. It typically happens from a refinance that's already owned or recognized value by Fannie or Freddie. So they can advertise that that may not be needed, but they can't say that it isn't required because they don't know until they actually run that through the system. Tony, did you want to add any more on that?
Yeah, I just want to, again, add a little bit of practical application commentary to it. And that is, once the desktops start being adopted and ordered, I think there are probably not going to be a ton of them in San Francisco, I would imagine, because, again, this is for conventional lending. So with the loan limits and so forth, there might not be a whole lot of them in San Francisco, and it's only going to be a small portion of loans that are going to be eligible for the desktops anyways. So I don't think it's, all of a sudden going to go from one day doing inspections to one day not doing inspections. It's going to be a definitely a slow transition, and it'll differ by area and differ by property. If you have an acreage property out who knows where, that's probably not going to qualify for a desktop type appraisal. And even if it does, the appraiser ultimately has the say-so on whether or not they're going to do a desktop on it. whether they feel comfortable doing it. An acreage property might have stables, barns, shops, those kinds of things that the appraiser doesn't know about. And that's where the rub's going to be. I know a lot of desktops are being sent out right now for non-conventional work because there are lenders that are doing them right now, and AMCs are sending them out. And most feedback that I get from appraisers is they're sending them out from anywhere from 125, 135, 150, 175 bucks is what they want the appraiser. That's what they want to pay the appraiser to do the appraisal after either somebody else has done the inspection or just from a desktop perspective. And a lot of appraisers frankly find that offensive. They really do. It would be like telling a realtor, well, by the way, now we want you guys to work at 1/10 of your 1/5 of your normal commission, but take on a lot of the same liability. And so a lot of this is certainly new territory to appraisers. There is a large swath of appraisers that are saying we're plain not going to do them. And I think from a practical aspect, once a desktop gets ordered, there may be some lenders that are going to try and push to have the desktop done. And for whatever reason on a particular property, or it's in a particular area, or the appraisers in that area don't want to do them, it's going to take a long time for the process to happen. It won't be, in some limited cases, I think it'll take longer. And it may just be a better idea for the lender just to say, you know what, let's just go ahead and do a full appraisal, because most appraisers will take that kind of stuff. And you can still do a full appraisal even if a desktop has been ordered. Certainly the lender and Fannie Mae will accept a full appraisal. So that's how it is going into it. I think just like all technologies with appraisers, it'll eventually get through to them. Appraisers resisted email, appraisers resisted digital photos, appraisers resisted digital transmission and uploading of their appraisals to AMC's. Appraisers resisted AMC's themselves. But everybody has moved along and in lockstep, and we're mostly on the same playing field these days. But I think the desktops are going to be few and far between. And the other issue, I think, is this also goes with what's called a hybrid appraisal, which is similar to a desktop. As a realtor, do you want somebody other than an appraiser doing the entire appraisal process? That's something to think about. And I know I was talking to a realtor yesterday in Mill Valley, and she said, absolutely not. I want an appraiser from start to finish. And, I don't care about timing. I don't, well, she does, but I don't care about cost. I want to know that the professional that's been trained in that part of the process, that's been doing it for years and has the experience, is going to be doing the whole thing. So there's that also. So it's definitely going to be an interesting spring coming up, because we have these and other changes coming along. But we'll see how it all goes. We'll eventually get there.
Well, thank you for your answers. Paula asks, it's kind of in the same framework of what your answer was. Is there general resistance within the appraisal banking system to modernize, to embrace the technology we have at our fingertips? And we have a bunch of other things to discuss today, but I would just say, generally speaking, yes, it is the answer there. It seems to be, it's like like the Titanic, shifting course. It's like it doesn't happen overnight. It happens over a long period of time. Once industry standards have been set, they can't change on a dime. And hopefully, we continue to have professionals doing this work, because I think it's needed. We're going to kind of transition to our more technical aspects. We got about 15 minutes left. Audience, feel free to ask questions in the Q&A. I don't have many listed. I've got a bunch of questions of my own, but if you have something specific that you want to answer, please ask in the Q&A box. A question I always get from new buyers, and I'm sure you've heard this many times before, but I always think it's fun to get answered. How do appraisers magically come up with a buyer's contract price 98% of the time? there's 26 offers, 35% over asking. Like, how does that contract price come in? How do they know, what that value is?
Yeah. So as appraisers, we're required to have a copy of the contract. That's the rules. That's the way it works. We get a copy of the contract. And just a reminder to all you realtors out there, make sure that if the appraiser asks for a copy of the contract, get them one that has all the signatures and all the addendums, because sometimes we miss that stuff, and that tends to put a monkey wrench in the gears. But we're required to have a copy of the contract. That doesn't mean it's going to come in at that number, but I mean, let's face it, appraisers know what number you're looking for. They know what number is going to satisfy all the parties. And generally in this environment, a $1 million property is not going to sell for $750,000. And it's always going to be at the upper end of the range because there's so much demand for properties here in the San Francisco Bay Area. So it's always going to be at the upper end of the range, and that's generally where the contract price is at the very, very upper end of the range. And so that's, if an appraiser has a $5,000 leeway either way, generally it's going to come in at the contract price. Now, again, that doesn't mean it's always going to come in at the contract price. We did have one yesterday that was a $2 million off-market purchase of a condo in San Francisco, and it came in at 1.8. Those things happen. And it was never tested on the open market. It was never offered to our knowledge on the open market. So, that's where the appraiser comes in and brings it in at exactly what they think it's worth. But we're generally not going to be, we're not allowed to be influenced as far as coming in at our number by the contract price. But in all practicality, everybody knows what the number is, and that's what appraisers are generally going to come in at, unless it's not worth it.
So let me add just a little codicil to that. So essentially, the issue becomes one of worth versus value, right? If it were just a contract price that needed to be met, and a lender was perfectly willing to make a loan based on an unvalued piece of property, then you wouldn't need an appraisal. But the fact is, that's not the way the system works. Lenders are looking for value. What is the data in the marketplace that supports that value? And in the markets that we've been in, where we've seen 20 and 30% increases of value in less than a year's time, in some cases, you're always going to be chasing the next market price, always. And you're always going to have buyers out there who are going to have more money than your clients. Somebody who wants that property, it's worth it to them to overpay for it or to pay more cash down. They may have sold another house. There are all kinds of situations. It's not an issue of fairness, right? Although I get how frustrating it is, but it is an issue of worth versus value. Right. This is one of the reasons why people at Guarantee who are in your secondary market division, why they don't sleep at night, Patrick. Because if in the following week, instead of having 5 houses on the market, you have 45 houses on the market, right? Those 5 that just got closed and were sold, all for $1 million plus. If you've got 45 similar properties on the market, you've got all those buyers now able to compete for those properties, and they're probably going to sell for a little less than $1 million, maybe, right? Because all this stuff is a function of supply and demand, and we've been in markets where there simply isn't adequate supply, and unfortunately, we'll probably be in that market for a while. But if all those properties sold for less than what similar properties just sold for, your secondary marketing people wouldn't be able to sell them in the secondary market and get the money out that they just spent to buy them. That's the issue of worth versus value.
Yeah, and I mean, I know it comes into play when there's flips also, when you
Yes.
have a property that, was just bought for, 1.2, there's some work done to it, it beautifies, there's a bunch of, demand for it and it sells for 1.8 or 1.9. And that happens sometimes within 3 months, right? Not all lenders will lend on that because it's considered a flip. We do have one of my questions, and one of the questions the audience asked are similar to what is allowed for the agents to say, and well, I should say, what is allowed for the appraisers to hear and to take into consideration of what's going on at the property, meaning, does demand on the property have any bearing on the appraiser's valuation? For instance, would it be prudent for an agent to share how many other offers there were? Is that able to influence, hey, there's 14 offers with, 2 backups? Is that something that can be taken into consideration?
Yeah, definitely. And, there's always a lot of confusion out there about what can a realtor say, what can a realtor not say, what can an appraiser say, what can an appraiser not say. Some appraisers will go in saying, I don't want to hear anything, with the, fingers in the ears and covering their eyes going through the appraisal. And they'll say, look, if you're trying to tell me about the comparables down the street, you're trying to influence me. Well, those things just are not true. In reality, a realtor can say literally whatever they want to say to an appraiser. An appraiser is under an obligation to not act on if somebody's trying to influence them one way or the other. It's not legal for a realtor to unduly influence an appraiser. A bottle of wine could be considered undue influence. Handing it to the appraiser when you're out there, or saying, hey, Mr. Appraiser, if you don't bring this in at the contract price, you're never going to work in this area again, because I know all the lenders out here. That's undue influence. But when we have a copy of the contract and we know the number that everybody's looking for, and the realtor comes in and hands a stack of comparables that they think are relevant to the appraiser, that's not undue influence. Realtors are allowed to be an advocate for their clients and for their transactions. Appraisers are not allowed to advocate for anything other than their own appraisal. It's probably more incumbent on the appraiser to make sure they're walking, making sure that they're not being influenced. No, you can talk about whatever you want. You can tell us down, hey, I think this property is worth X amount. That's fine. As appraisers, we're data miners. We're looking for data all the time. That's all we do all day, is gather data and then put it into a report and analyze it and send it out. And so that's what we're looking for all the time. We're looking for data, and we want more data. For the most part, appraisers that aren't looking for more data, those are the ones you're going to have trouble with.
What do you think would be the most prudent way for a agent to provide this information, right? So if you show up, you're an appraiser, and I'm like, hey, there was 14 offers, and or what if I, write out something and say,
Yeah.
here, would that be the preferable way?
Yeah, right. Yeah, have borrowers all the time write love letters to get their offer accepted. And I'm not saying write a love letter, but an informational letter in writing from the listing agent saying, hey, these are how many offers we had. This was the range. We've got this many in backup. This is how long it took to get the property into contract. And here's a list of comparables that we think are relevant and why. And maybe there's a low one down the street that just sold, but it was had a NOD filed on it, or it was a divorce, or whatever the reason was that it sold low. All of that is great information, including how many offers you had on it, and that's information that we want to have. As a matter of fact, as appraisers, we have to analyze the current agreement of sale, and part of analyzing the current agreement of sale and the listing history of the subject is to talk about how many offers you had on the property. So we want that information.
Great.
So let me add a quick comment here. There are some schools of thought now that and some lenders that won't accept those letters. They won't do loans when those are involved. And one of the reasons is because people include pictures of themselves and descriptions of their family and talk about the things that they do. And there is the potential influence that someone would be favoring someone of a certain ethnicity based on that. And it should be purely decided on the merits of the contract. That's just, that's the degree to which some of the stuff is starting to filter through.
Well, I mean, I think we want protections in place. For instance, there's somebody in the chat who asked, couldn't an appraiser, discriminate on a buyer based on a surname that's written in the contract?
Well, and that's right. The first time I've heard somebody bring that issue up, but that's true. That is true. So we're never going to escape all of the little areas that could potentially, I was going to say could potentially color somebody's decision, but that's probably the wrong term to use. But yes, that's right.
Now, and to the technology standpoint, I mean, we always want a professional to do the job that is at task, whether it's a contractor doing work on a home or an appraiser or a realtor doing their job, right? We don't want a computer doing this. But could technology take some of this bias out, or would it add its own?
Well, I think it adds its own. I mean, first of all, technology isn't created in a vacuum, right? You still have to have people that program that. I've got some friends that are working on a committee, actually through CRN, to try and develop standards for automated valuation models. There are no standards, by the way. Nobody knows actually how any particular AVM works. I mean, they think they know, but they don't. And that's why they create these cascades, which range in value. The GSEs will tell you, well, we run cascades of AVMs and they can be off by 10%. Well, what they're not telling you is they can be 10% lower or 10% higher. So you've got a range of 20% in terms of value that they could disagree with. Technology can do a lot of things. I don't think it captures the kind of information that a good realtor knows, a good lender knows, and a good appraiser knows. I don't think it filters information, data into information, into insight, the way that a human brain does. And I don't think it will for a long time. I think it's a good tool. I think it has utility. I think it works in certain bandwidths, but it's not the solution. And the solution is here with all of the people that are on this call, who are interested in trying to find solutions on how not to be biased, how to serve people in a fair and just way, right? How to do things that are ethical and support their communities, right? There's the solution, not just technology.
Agreed. We are the solution we want to see and we want to be. Next question, and guys, we might run over a little bit, audience and panelists, if that's okay. It's just about 2 o'clock. You guys have a little bit more time for us?
Yeah, a little more.
Thank you.
Sure.
Agents in San Francisco are weaned off of the price per square foot approach to value. Do appraisers ever consider the price per square foot, or is it always a weighing of the variables, which this person has argued for?
Yeah, I'll take this one to start. With price per square foot can vary hugely. I'm looking at an appraisal right here for a property in Merced that was just done for us, and of the 6 comparables, and again, that's Merced, but it does go from a low of $82 a square foot to a high of $210 a square foot. So where do you pick? I mean, that's a pretty wide range. And there's a lot of things that can influence that: views, remodeling, pools, amenities, time. All those things have a huge impact on price per square foot. I just, as a matter of fact, ran some data for this call because I wanted to be prepared, but ran all the sales in San Francisco over this past year. And there's properties that are selling for upwards of $4,000 a square foot now. And there's a lot of them that are around $1,000 a square foot. So and these are interspersed throughout the city. So realtors use that commonly, but appraisers, we tend to stay away from a pure dollar per square foot as a way of analyzing things, other than analyzing changes in time, which I use a methodology for doing that. Changes in prices over time. That differs from square footage adjustments that are on a dollar per square foot basis. And those are calculated in various ways, but those are generally going to be quite a bit less than the dollar per square foot realtors use, because the dollar per square foot realtors use includes the land. And appraisers, we don't include the land when we're making our square footage adjustments. So that's kind of the big difference, and they're just used for two different things. Yeah.
Okay.
Yeah, the fact is that cost per square foot is an extracted cost. The appraiser doesn't use it to develop their opinion of value. It's just a calculation that they make after the fact. I think confusion for most realtors is when they see one property versus another property and they think it's comparable, they look at the cost per square foot and then multiply it by how many square feet that other property is bigger or smaller. And then they figure that's how much more their property should be worth. And that's just not the way it works, right? Yeah, I mean, it's just not the way it works. So.
All right, so we got about 5 to 10 more minutes, hopefully. And I just want to make I know that this is tough ask, but I'd like to make our responses a little shorter, just so we can jump. We got a lot to cover, and I hope to have you guys back on again, because there's just so much, rich information here for our membership, and I hope they appreciate your time. Just to kind of sum up one question, there was a property in San Francisco, came in and sold $1 million over asking. The question is, how do appraisers see this, and will not now be a par or a comp for the rest of the properties that are like it in the area? Or is that, maybe a one-off situation with those variables in a higher degree, finishes, standards, what amenities that drove that price?
Yeah, I think, certainly, it's going to be really interesting this spring, because I've talked to realtors and so forth, and they said, yeah, coming up this spring and even starting right now, I'll use the realtor that I spoke to yesterday in Mill Valley as an example. She said, I really don't know, I had my way of pricing properties before, but she said, that's kind of out the window now. I really don't know how to price properties anymore. Based on, she had one that was a sale for 2.6, listing for 2.6, and it sold for 4. The interesting issue about that one was that wasn't the only one in Mill Valley that's like that. So these things are becoming more and more common, and appraisers are more and more used to being able to address why a property is selling for so much over list. And a lot of it is marketing techniques. This realtor that I talked to yesterday, she said normally what she used to do was figure out what she thought the property was worth and price it $500,000 under that. To start building up a lot of momentum and a lot of demand and a lot of incentive for people to come in and make offers, because they see that lower price, and it blows the price through the roof. And that was her technique. And appraisers, I think, understand that more and more now. And that is also a regional technique. You go to Oakland and Berkeley and some, San Francisco and maybe the south part of Marin, that's what a lot of realtors do. But you go to other areas and realtors don't use that technique quite as often to price their properties. I don't think those are one-offs anymore, unless you're in an area where things tend to sell 10% over list price, and you have one that that sold 40% over list price. The appraisers, it's incumbent upon them to analyze that property, call up the realtor, figure out how they marketed it, figure out why it sold for that much over list price. And I don't think they're going to just discard it. They probably would still want to use it. But just, in their ultimate analysis, they'll maybe weight that property a little less or a little bit differently.
Okay.
So Patrick, you have two questions in your chat box that are mirror images of themselves.
Yes.
One's from Ann. How do you handle homes that are legally 2 units that are used as a single family home? And then the converse from Hector, which says, prior question, dealing with multiple units as a single family home or a single family home used as 2 or more rental units. San Francisco is a unique area, but basically this is a highest and best use question, right? What is the highest and best use? If the property is more if it's zoned for 2 units, it can be used as 2 units. But if the value is greater as a single family home, which in San Francisco is possible, right? It could also be a single family home with an auxiliary unit, right? An ADU. It's unique to each particular property, right? Unique to each particular property. But great questions.
Yeah, we had an interesting one yesterday, actually for a property in Sacramento yesterday. It was a really, really nice mid-century modern 3,000 square foot, 3,200 square foot home that had a 800 square foot accessory dwelling unit, zoned for single family, but if the lot was big enough, you could put a duplex there. And the listing agent wrote all over the listing, calling it multiple units, and talking about the income that additional unit could offset your mortgage. And so the investor, a big national lender that was the investor, said, hey, we need the appraiser. It was ordered as a single family, and the appraiser did it as a single family with an accessory dwelling unit, which was proper. But they said, no, we want this changed to a multifamily, which is a different form, multifamily property, because the listing says it's a multifamily property. And the language that the realtor used says that it's a multifamily property. And the appraiser actually wasn't as clear as they should have been in describing the property, kind of mixing around a few metaphors for a multi-unit property. So that kind of confused everybody. And ultimately, that lender wouldn't do the loan because there was too much question as to what the property was. They were able to find another lender to fund the loan as a single family home, because that's really what the property is. But yeah, it can be difficult to distinguish between the two, but ultimately it's up to the appraiser to figure out what the highest and best use is, like Mike said. And in this case, it was definitely as a single family home. And but there's always a few monkey wrenches that can be thrown in, that's for sure.
And just to add to that, it should be zoned and registered through the city, county additionally, right? As a single family dwelling with an ADU versus a 2-unit.
Yeah, most single family zoning now allows accessory dwelling units. Yeah.
All right. Well, I'm going to cut off audience questions here, ask 2 quick ones for you guys, and then that'll be our wrap up. Thank you so much again for giving us so much of your time. And as you can see from the audience questions, they're eager for information and would love to have you back a 3rd time. So maybe we'll schedule that after the hectic spring settles and we have some new data and some new things to report on. And thanks for your efforts in diversifying the industry. So first question is, and if you can answer this shortly,
sure.
What impact has COVID had on turn times and prices for reports? And then lastly, do we expect that the spring will calm down a little bit for appraisers now that rates are going up?
Okay, I'll take the last one first. No, it's going to be crazier. I think there's probably going to be a little more, there might be incentive for sellers to bring some more properties on the market because rates are going up, and they've got to, if they're going to sell, it's time to sell now because rates are going up and the buyers are going to go away. That's kind of the thinking that some people might have. So they may get some more properties on the market, but ultimately, if you put your home on the market, you got to have a place to move to. So we all know this. It's a catch-22 situation. So I think we're still, I mentioned this one in Pleasanton that we had 48 offers on last week. It's going to be a crazy spring. That's my prediction, with lots of overbids, lots of multiple offer scenarios. If you think last spring was crazy, yeah, you're in for a new ride on this one. And as far as COVID goes, on making things faster and cheaper, nope. Especially on multifamily properties. Our experience has been on multifamily properties. A lot of tenants make it harder to get into the property, or just plain tenant occupied properties. We found that it takes a little bit longer. We had one last year where they actually put a little spacesuit on in that they had bought new on the front porch, and wanted the appraiser to climb into it, a little hazmat suit, and put that on before they came into the house. And I've got a picture of the appraiser with that suit on. And we get requests from mostly tenants that say, I want the appraiser to have a test within 72 hours before they come into my house. And then on top of that, I want gloves, booties, masks, and a shield. And I want to see their backs card, so it gets a little complicated sometimes. So no, it's not taking any less time, and no, fees are not backing down because of it. No.
Yeah, I basically disagree. I basically agree with all of that. Yeah, I don't disagree with what Tony said.
You should see Mike in his spacesuit. Yeah.
Yeah.
So generally speaking, appraisals, let's say in San Francisco for a single family home, done in how long right now? Let's say I ordered it today, 2 weeks, 3 weeks, 4 weeks.
I think that's the norm, just depending on the property type, who the lender is, their relationships and so forth. Apple Appraisal, we're able to get things done in certain cases substantially faster. We've got a couple of special programs that allow that. But I would say on average, you're probably talking 10 days, maybe 2 weeks.
Okay, and then costs for something to get done quickly?
I would say starting at $750 and moving up from there. Yeah, up to a lot.
What's interesting, Patrick, is that typically the complaint is that appraisers won't take the lower priced properties. They just won't take those assignments. But what's changed with COVID is that they found that they can charge almost as much for a simpler assignment, that it doesn't pay them to take the more expensive complex assignments. So now the person that's got a $6 million house in Pack Heights, well, maybe that's a little low, that nobody wants to take that because it's going to take them so long to find the comps, to go in and see the house and do, the assignment. They can do 5 smaller properties and make more money. So I was talking to someone the other day about this and opining that now we're going to have a whole different class of people complaining about being prejudiced about getting assignments done, and people with louder voices, which in some ways is kind of unfortunate. But I mean, that's what's happened to we'll find the equilibrium. The equilibrium will return, right? We'll get a little more sanity into the marketplace.
Well, here's to everyone having a prosperous finish to winter and emerging spring. Thank you for being on again, audience. Thanks for tuning in, and your SFAR Education and Events Committee. Thanks you. Take care, guys.
Thank you very much.
Thanks for coming.